Welcome to Breaking News to Trading Moves.
Thanks for having me.
Today, we are looking at a specific set of developments centered around Blue Owl Capital
Right.
and really what is happening in the broader private credit market overall.
It is a focused look at how a single headline can illustrate exactly where the money is going
Yeah,
and where it is leaving.
exactly. We are going to look at the specific companies that land in the winner and loser columns based on the recent news.
Mm-hmm.
To set the stage here, the core event involves Blue Owl.
Yes.
They took steps that effectively limited liquidity for investors in one of their private credit vehicles.
And from what we are seeing, they also sold a specific portion of loans and returned capital.
Right, but they did it in a way that investors did not necessarily expect.
And that is the catalyst.
The immediate market reaction is to view this as a stress test.
Yeah.
Because, this isn't just about one fund.
Yeah.
It is being read as a test for the entire private credit model.
Because the central tension here, which we see mentioned over and over in the coverage, is this idea of a liquidity mismatch.
Right, the liquidity mismatch. Let's define that before we get into the tickers. What exactly is the mismatch in this context?
It is fairly straightforward mechanics. On one side, you have private credit,
Okay,
and by definition, these involve loans that are illiquid.
meaning they're hard to sell.
Precisely. They are hard to sell. You cannot just click a button and be out of them in a split second like you might with a large cap stock.
Right.
You are lending money to a company for 5 or 7 years.
But on the other side of that equation, you have the investment products themselves.
Exactly. Many of these products promise periodic liquidity.
They offer opportunities for investors to cash out.
Yes, at
Right.
certain intervals, monthly or quarterly.
Okay.
So you have a promise of liquidity backed by assets that are fundamentally illiquid.
And there is the mismatch,
That is the mismatch.
which leads us to the mechanism of redemption psychology.
It does. When investors start to get nervous,
When they rush for the exit, as the text puts it.
right, when they rush for the exit, the funds face a really difficult choice.
Because they have to meet those redemption requests.
Exactly. To meet those requests, they may be forced to sell assets.
And because those assets are illiquid, they often have to sell them at discounts.
Or, as we saw in this headline, they might have to gate or restrict redemptions entirely.
And it is worth noting for you listening that this isn't a niche corner of the market anymore.
No, not at all.
Private credit has grown quite large,
It has, and it overlaps with public markets now.
specifically through business development companies.
Right, the BDCs and the listed alternative asset managers.
So when we see a stress test like this, we have to look at who is exposed,
We do.
which brings us to our roadmap. We're going to walk through the specific winners and losers identified in the coverage.
And we will be breaking down the ticker symbols for each company mentioned.
Let's start with the entities that are right on the front line of this narrative.
The losers, so to speak.
Right. These are the companies directly tied to investor confidence regarding those liquidity windows.
And the net asset value, or NAV marks.
The first name here is the one making the headlines, Blue Owl Capital,
Ticker symbol OWL.
OWL. They are in this category because they are the specific focus of the news.
The vehicle in question faces the immediate pressure of sentiment.
So what happens when that sentiment turns?
Well, the narrative here is about the reliability of the redemption features investors counted on.
If investors thought they could get their money out easily, and that changes,
Sentiment sours.
it changes the calculation for holding the stock.
Exactly. And when sentiment sours regarding the ability to cash out the discounts to NAV can widen.
Right, because if the market believes that the assets are harder to exit, they price that risk in.
It is no longer just about the yield, it is about the accessibility of the capital.
Okay, the next name in this frontline bucket is FSKKR Capital.
The ticker is FSK.
FSK.
This is another vehicle where that confidence is crucial.
It is about the perception of the liquidity window again.
Yes. If the market is reading the Blue Owl news as a stress test for the model, then peers like FSK face similar scrutiny.
It sounds like the market is asking a very specific question.
The question becomes, is this a specific issue or is this a structural issue?
And in the short term, the market often assumes the structural view to be safe.
They apply the logic of the headline to the peer group?
They definitely do. So those are the direct players. But then we had the guilt by association category.
These are the other listed alternative asset managers.
Yes, this is where we see how improved correlation works in a sell-off.
Even if the fundamentals of these other managers are completely different from Blue Owl's specific situation, investors tend to de-risk.
They sell first and check the details later.
Precisely. They might rotate out of alternatives entirely,
The market begins pricing in things like slower fundraising,
or fee pressure for the whole group.
regardless of the individual specifics.
Right.
The first ticker mentioned here is Ares Management. That is symbol ARES.
Ares has a very large private credit footprint.
So when the narrative is that private credit is facing a liquidity test,
Ares is going to feel that pressure in its stock price.
and the second one is Apollo Global Management, ticker symbol APO.
APO.
Same dynamic.
These are massive firms, but the market mechanism is about the flow of funds.
If the expectation is that fundraising will slow down across the industry because investors are spooked, then the future earnings of these managers get repriced downwards.
Because those earnings rely on fees from those funds.
Exactly.
Now let's look at the third group within the loser section. This is the contagion trade.
The contagion trade involving public BDC peers.
This is a very specific technical dynamic that is worth understanding.
We are talking about business development companies that trade publicly.
We have two main names listed here. First, Ares Capital, ticker symbol ARCC.
ARCC?
And second, Blackstone Secured Lending Fund, ticker symbol DXSSL.
BXSL. Here is the mechanism. These BDCs trade daily on the stock market.
You can buy and sell their shares instantly. However, the assets they own,
The loans inside the BDC.
right, the loans do not trade daily. They are illiquid.
So you have a price for the stock that moves every second and a value for the portfolio that moves much slower.
Exactly. The portfolio has marks or valuations that adjust periodically.
But in a headline-driven sell-off, the share price of the BDC can drop much faster than those marks adjust.
So the stock price disconnects from the stated value of the assets.
It creates a widening discount.
The trading price drops below the actual asset value, or what the asset value is stated to be anyway.
Which puts further pressure on market sentiment.
Because it looks like the market has lost faith in the underlying value of the loans.
It seems like fear acts as the catalyst here. Even if the underlying loans are performing fine, the structure creates volatility in the public tickers.
That is the liquidity mismatch in action.
Okay, let's pivot. We have discussed who is feeling the heat. Now let's look at who benefits.
We're moving to the winners.
Specifically, the beneficiaries of volatility and hedging.
When credit headlines spark uncertainty, two things generally happen.
First, hedging demand rises.
People want to protect their portfolios.
Second, trading volumes increase as people move money around.
And there are platforms that facilitate exactly that.
The exchanges.
Correct. These are the infrastructure providers where this trading activity happens.
The first ticker here is CME Group, symbol CME.
CME. They operate the derivatives marketplace.
So when uncertainty drives market participants to buy protection,
Or hedge their exposure, they often utilize products traded on CME.
and the second is Intercontinental Exchange, ticker symbol ICE.
ICE. Similar logic. These platforms support the exchanges.
Increased volume generally translates to increased fees and activity for these infrastructure providers.
They don't take the credit risk themselves. They provide the venue for the market to sort out that risk.
So in a risk-off or volatile environment, they often see an uptick in activity.
So while the asset managers are worrying about valuations, the exchanges are just processing the pickets.
Volume is volume, and usually uncertainty brings volume.
It does.
Moving on to the winners in flight to quality and information.
This is about data. As investors reassess credit, risk the dynamic changes.
They stop assuming safety and start checking the details.
They need to distinguish between what is safe and what is dangerous.
Right, and that drives demand for ratings, analytics, and benchmarks.
Institutional credit workflows rely heavily on these third-party verifications.
The first name mentioned is Moody's, ticker symbol MTO.
MCO, a classic name in ratings.
When the market gets jittery about credit quality, the value of a rating goes up.
Investors want that stamp of approval, or at least the data to make their own decision.
And the second is S&P Global, ticker symbol SPGI.
SPGI, same space. In a risk-off environment, reliable data becomes a premium asset.
You aren't just buying the yield anymore. You are buying the certainty.
And these companies sell that certainty in the form of analytics and risk tools.
It makes sense. When things are calm, maybe you skim the report. When things are volatile, you buy the premium subscription.
That is a fair way to put it. The demand for scrutiny increases.
Now let's look at arguably one of the specific movements regarding where borrowers go for money.
The winners among traditional lenders and capital markets.
We call this the potential transfer of market share.
If private credit fundraising slows down due to these liquidity fears, borrowers still need money.
So if the private credit window is closed or expensive, where do they go?
They head back toward the traditional avenues, syndicated loans and high-yield issuance.
Which brings us to the big banks. The first ticker is JP Morgan Chase, symbol JPM.
JPM. And the second one usually mentioned in this breath is Goldman Sachs, ticker symbol GS.
So why do they win?
Because this marks a return to bank-old financing.
For a while, private credit was taking market share away from these banks.
They were doing the deals that banks used to do. But if private credit stumbles, the borrowing activity moves back.
And the banks earn fees on that.
They earn fees and spread income from these activities.
They reclaim territory that private credit had previously taken.
It is a cyclical dynamic. When the new model hits a snag, the old model often picks up the slack.
So we have covered the losers, the private credit vehicles and managers.
And the winners, the exchanges, the data providers, and the traditional banks.
Now let's look at the key market mechanisms to watch.
We need to review the why behind the trade. The text mentions a risk-off tape.
What does that actually mean for the companies trying to borrow money?
It means financing tightens. It gets harder or more expensive to get a loan.
This is especially true for leveraged borrowers.
The coverage mentions specific sectors that are already under pressure. Software borrowers were singled out.
Right. If you are a software company with high leverage and the private credit market gets tight, you are in a difficult spot.
And we also need to keep an eye on that mark valuation issue.
This is central. If investors doubt the valuations,
The marks of private assets.
or if they fear gates being put up, the selling pressure hits anything that looks similar.
It is the structure that creates the volatility.
Yes. Even if the underlying loans are performing fine, the structure creates the fear.
That liquidity mismatch.
And fear acts as the catalyst driving the price action in the public tickers linked to the space.
It really highlights how interconnected these mechanisms are.
You pull one lever at Blue Owl, and a bank stock or an exchange stock moves in response.
That is the nature of the ecosystem.
So to recap what we have covered for you today,
The situation started with Blue Owl's moves. This highlighted a liquidity mismatch causing stress in private credit.
we saw the flow of capital moving away from the losers, the private credit vehicles like OWL and FSK.
When the managers like ARES and APO,
And we saw the potential flow toward the winners, the hedging tools like CME,
the data providers like MCO.
and the traditional banks like JPM.
It is a clear example of how a single operational decision can highlight a broader structural reality in the market.
And that is why we watch the flows.
Def-
Something for you to consider moving forward. When looking at these structures, ask yourself if the promise of liquidity matches the reality of the underlying asset.
Because as we have seen, when those two things diverge, the market reacts quickly.
Before we go, we must state that this content is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research.
Thank you for tuning in to Breaking News, to Trading Moves. Watch how this liquidity narrative evolves.